Ladies and gentlemen, pause for a moment and really listen to the world around you. The headlines are loud, the markets are shaking, and uncertainty feels heavier than ever. But here's the truth most people miss. The biggest shifts in history never arrive quietly. They arrive disguised as chaos. Today's title may sound dramatic, but it captures a turning point many will only understand in hindsight. Game over. JP Morgan flips long, and China's ban starts in 4 days. This is not just about banks, trades, or geopolitics. This is about mindset. This is about P reparation. And most importantly, this is about recognizing opportunity when fear dominates the room. When a dominant financial institution decisively shifts its market stance, it is never an impulsive act driven by short-term headlines. Such a move reflects an internal consensus built on months of quantitative modeling, macroeconomic surveillance, and risk-weighted forecasting that aims to identify where imbalances will emerge next. This is why institutional positioning often changes while public sentiment remains conflicted or pessimistic. The real hook is this. By the time confidence returns to the mainstream, the most powerful capital has already taken its seat at the table. Large institutions are structurally conservative by design. Their first objective is capital preservation, not speculation. As a result, they tend to remain defensive well beyond the point where risks peak. When that defense finally gives way to a long position, it suggests that downside threats have been largely priced in and that future conditions now favor exposure. This transition typically occurs during periods of confusion, when economic data sends mixed signals and narratives compete for dominance. These moments feel uncomfortable, but discomfort is often the market's way of signaling that a regime shift is underway. What separates institutional behavior from retail reaction is timing. Institutions position for probabilities, not confirmation. They understand that waiting for perfect clarity erodes returns and compresses opportunity. Markets move ahead of economic data, not behind it, and capital that arrives early benefits from asymmetric risk-reward dynamics. This creates a powerful advantage that is invisible to those who rely solely on surface-level indicators or delayed consensus views. The market does not announce turning points, it whispers them through positioning. Scale amplifies the importance of these moves. When major institutions go long, their capital deployment influences liquidity, derivatives pricing, and cross-asset correlations. This can initiate feedback loops that gradually force other market participants to adjust, often at higher prices and with greater risk. In this way, institutional positioning is not merely reflective of expectations. It actively shapes the environment others must operate within. The hook here is subtle but critical. Ignoring these signals does not preserve neutrality. It leaves one reacting to a market already in motion. At its core, a long shift by a major institution implies confidence in forward demand, tightening supply, or improving financial conditions that are not yet obvious in the data. It represents a calculated belief that the next phase of the economic cycle will reward commitment rather than caution. Those who learn to read these signals early are not chasing certainty. They are aligning themselves with the direction. Capital is already flowing long before the crowd realizes the game has changed. When a policy announcement comes with a fixed deadline, it immediately alters market behavior in ways that open-ended guidance never can. A countdown compresses time, and in economics, compressed time magnifies pressure. Participants who might otherwise delay decisions are forced to act, hedge, or reposition often simultaneously. This is where volatility is born, not from uncertainty alone, but from urgency. The real hook is that markets do not wait for the deadline to arrive. They begin adjusting the moment the clock starts ticking. Deadlines reduce flexibility across the system. Supply chains, manufacturers, traders, and investors all lose the luxury of optionality and must commit capital earlier than planned. This creates front-loaded demand, inventory hoarding, accelerated contracts, and defensive positioning, all of which distort normal pricing mechanisms. Prices move not because fundamentals suddenly changed, but because timing did. In these moments, markets are no longer debating value. They are responding to constraint. Those who understand this dynamic recognize that price spikes and liquidity stress are not anomalies, but predictable consequences of forced synchronization. Another powerful effect of policy deadlines is information exposure. As the deadline approaches, weak hands are revealed. Firms with fragile balance sheets, poor access to alternatives, or inefficient logistics are compelled to transact under pressure, often at unfavorable terms. Stronger players, by contrast, exploit this urgency by providing liquidity or capacity at a premium. The hook here is subtle but decisive. Deadlines act as stress tests, separating resilience from vulnerability in real time long before official data reflects the damage. From a capital markets perspective, fixed timelines also accelerate hedging behavior. Derivatives markets respond quickly as participants attempt to lock in prices, protect margins, or speculate on dislocations. This surge in hedging demand can steepen curves, widen spreads, and amplify short-term volatility well beyond what fundamentals alone would justify. Yet this volatility is not random. It is structured around the deadline itself. The closer the event, the sharper the reactions. Creating windows where pricing becomes more emotional than rational. Perhaps the most underestimated consequence is narrative compression. A deadline forces a single story to dominate markets. Psychology, crowding out nuance and long-term analysis, everything becomes framed around what happens before and after a specific date. This narrowing of focus creates mispricings as markets overemphasize immediate outcomes while underpricing second-order effects. Those who remain disciplined during these periods understand that the real opportunity often lies not in the event itself, but in the aftermath. When rushed decisions unwind and reality reasserts itself, but in modern economics, control over critical resources has become one of the most decisive forms of power, often outweighing traditional measures such as GDP growth or monetary expansion. When a nation or bloc exerts influence over essential inputs, transportation routes, or processing capacity, it gains the ability to shape prices rather than merely respond to them. The hook is simple but unsettling. Market may appear free, but pricing power always belongs to those who control the bottlenecks. Resource control introduces asymmetry into global trade. Countries and corporations that dominate production, refining, or distribution are not forced to compete on equal terms. They can dictate conditions. This dynamic becomes most visible during periods of restriction when supply is intentionally limited or access is strategically reduced. Prices rise not because demand explodes overnight, but because alternatives are scarce, slow to develop, or prohibitively expensive. In such environments, economic leverage shifts rapidly, rewarding preparedness and punishing dependency. What makes resource control particularly powerful is its delayed visibility. The initial announcement of restrictions may seem symbolic, yet the real impact unfolds gradually as inventories decline and substitutes fail to scale. This lag creates a false sense of security among unprepared participants who assume markets will adapt seamlessly. The hook here is that adaptation is neither instant nor evenly distributed. Those with diversified access and long-term contracts remain insulated, while others face escalating costs and shrinking margins with little room to maneuver. Pricing power derived from resource dominance also reshapes negotiation dynamics. Importers lose leverage as urgency increases, while exporters can extract premiums, impose stricter terms, or prioritize strategic partners. This recalibration extends beyond commodities into currency flows, trade balances, and capital allocation decisions. Investors and firms are forced to reassess exposure not based on growth potential alone, but on vulnerability to supply constraints. Economic strength, in this context, becomes less about expansion and more about resilience. Perhaps the most underestimated aspect is how resource control influences behavior long before shortages become visible. Anticipation of restricted access triggers preemptive buying, stockpiling, and speculative positioning, all of which tighten markets further. This feedback loop reinforces pricing power and accelerates the very outcomes policymakers and dominant players anticipate. The uncomfortable truth is that once control is established, markets rarely revert to prior equilibrium quickly. Those who understand this dynamic do not wait for scarcity to appear in the data. They recognize that control itself is a signal, and pricing is merely its consequence. Volatility is often framed as a threat, but in economic reality, it functions as a mechanism through which value is redistributed. Markets do not eliminate wealth during periods of instability. They reallocate it from those who react emotionally to those who operate with structure and discipline. The hook is that every sharp move, every sudden spike or collapse represents a decision being made under pressure, and pressure always favors preparation over prediction. When volatility rises, information asymmetry becomes more pronounced. Participants with predefined risk frameworks liquidity buffers, and clear time horizons are able to act decisively, while others are forced into defensive behavior. This divergence is where value transfer occurs. Panic selling, rushed hedging, and poorly timed exits provide entry points for capital that understands the difference between short-term noise and long-term dislocation. Volatility exposes weaknesses that remain hidden during stable periods, revealing who is managing risk and who is merely hoping for continuity. Another critical aspect is liquidity. In calm markets, liquidity appears abundant and forgiving. During volatile phases, it becomes selective and expensive. Those who rely on constant access to liquidity often discover too late that it evaporates precisely when it is most needed. Institutions and disciplined investors, by contrast, treat liquidity as a strategic asset, preserving it during calm periods so it can be deployed when others are constrained. The hook here is counterintuitive. The greatest opportunities emerge when liquidity feels scarce, not when it feels comfortable. Volatility also accelerates repricing across correlated assets. Movements in one market force adjustments in others, creating chains of reaction that amplify both risk and opportunity. Participants who understand these linkages can anticipate secondary effects rather than reacting to primary shocks. This ability to think in systems rather than isolated instruments allows capital to move ahead of the crowd. Those who fail to recognize these connections often mistake volatility for randomness, when in fact it follows identifiable patterns shaped by leverage, margin requirements, and behavioral responses. At a deeper level, volatility reshapes market psychology. It shortens time horizons, intensifies fear, and narrows focus to immediate survival. This psychological compression is where disciplined actors gain their edge. While the majority seeks certainty before acting, markets reward those who accept uncertainty as the cost of opportunity. Volatility does not punish participation, it punishes indecision. And those who understand it as a transfer mechanism align themselves with its flow, allowing instability to work in their favor rather than against them. Markets rarely move in lockstep with public understanding. There is always a lag between institutional action and mainstream recognition, and it is in this gap that the most profitable opportunities exist. The hook is simple. The crowd rarely sees the turning point until it is too late, while those who can interpret early signals gain a decisive advantage. Recognizing these windows requires not luck, but disciplined observation and a deep understanding of market mechanics. When institutions take positions ahead of consensus, they signal expectations about fundamentals that are not yet obvious in economic data or headlines. This creates a temporal arbitrage. Capital flows into assets before broader awareness drives prices to reflect true value. Many participants wait for validation from news, reports, or analyst commentary, only to find themselves chasing an already established trend. The advantage lies with those who act on the signals before consensus solidifies. The hook here is that markets reward anticipation, not reaction. And timing is often more critical than accuracy in forecasting. This narrative lag is amplified during periods of uncertainty or policy shifts. When macroeconomic signals are mixed or geopolitical developments are unfolding, most market participants hesitate. At a deeper level, volatility reshapes market psychology. It shortens time horizons, intensifies fear, and narrows focus to immediate survival. This psychological compression is where disciplined actors gain their edge. While the majority seeks certainty before acting, markets reward those who accept uncertainty as the cost of opportunity. Volatility does not punish participation, it punishes indecision. Those who understand it as a transfer mechanism align themselves with its flow, allowing instability to work in their favor rather than against them. Markets rarely move in lockstep with public understanding. There is always a lag between institutional action and mainstream recognition, and it is in this gap that the most profitable opportunities exist. The hook is simple. The crowd rarely sees the turning point until it is too late, while those who can interpret early signals gain a decisive advantage. Recognizing these windows requires not luck, but disciplined observation and a deep understanding of market mechanics. When institutions take positions ahead of consensus, they signal expectations about fundamentals that are not yet obvious in economic data or headlines. This creates a temporal arbitrage. Capital flows into assets before broader awareness drives prices to reflect true value. Many participants wait for validation from news, reports, or analyst commentary, only to find themselves chasing an already established trend. The advantage lies with those who act on the signals before consensus solidifies. The hook here is that markets reward anticipation, not reaction, and timing is often more critical than accuracy in forecasting. This narrative lag is amplified during periods of uncertainty or policy shifts. When macroeconomic signals are mixed or geopolitical developments are unfolding, most market participants hesitate. At a deeper level, volatility reshapes market psychology. It shortens time horizons, intensifies fear, and narrows focus to immediate survival. This psychological compression is where disciplined actors gain their edge. While the majority seeks certainty before acting, markets reward those who accept uncertainty as the cost of opportunity. Volatility does not punish participation, it punishes indecision. Those who understand it as a transfer mechanism align themselves with its flow, allowing instability to work in their favor rather than against them. Markets rarely move in lockstep with public understanding. There is always a lag between institutional action and mainstream recognition, and it is in this gap that the most profitable opportunities exist. The hook is simple. The crowd rarely sees the turning point until it is too late. While those who can interpret early signals gain a decisive advantage, recognizing these windows requires not luck, but disciplined observation and a deep understanding of market mechanics. When institutions take positions ahead of consensus, they signal expectations about fundamentals that are not yet obvious in economic data or headlines. This creates a temporal arbitrage. Capital flows into assets before broader awareness drives prices to reflect true value. Many participants wait for validation from news, reports, or analyst commentary, only to find themselves chasing an already established trend. The advantage lies with those who act on the signals before consensus solidifies. The hook here is that markets reward anticipation, not reaction, and timing is often more critical than accuracy in forecasting. This narrative lag is amplified during periods of uncertainty or policy shifts. When macroeconomic signals are mixed or geopolitical developments are unfolding, most market participants hesitate, preferring to observe rather than engage. Meanwhile, institutional actors analyze the same information, identify probable outcomes, and position accordingly. The discrepancy between analysis and action is where opportunity emerges. Those who understand that hesitation carries implicit cost can capture value that others overlook, turning inaction by the majority into active advantage for the minority. Another dimension is the psychology of perception. When early movers act, they often do so quietly, without triggering widespread awareness. By the time public attention focuses on the asset, momentum is already in motion. Traders and investors who rely solely on visible signals are effectively responding to the aftermath rather than the catalyst. The hook is subtle. Real insight is often invisible. In the market, as loudest signals come after positions have already been established by those who anticipated them. The lag between action and awareness also creates asymmetry in risk-reward. Those who enter positions early face temporary uncertainty but are positioned to benefit from the full price adjustment. Once broader recognition occurs, those who wait for clarity may have lower perceived risk but sacrifice potential gains. Understanding and exploiting this window requires patience, confidence, and a willingness to act before confirmation arrives. The crowd follows the visible trend, but those who interpret signals correctly move ahead of it, capturing advantage precisely because they operate where most participants cannot yet see. In economics, one of the most underestimated risks is not making a wrong decision, but failing to make any decision at all. Opportunity cost quietly accumulates while indecision persists, and the markets reward action far more consistently than hesitation. The hook is that in times of structural shifts, sitting on the sidelines often carries a higher cost than choosing the wrong position because capital and influence continue to move, leaving the passive behind. When market conditions begin to change, whether through policy announcements, institutional repositioning, or shifts in supply and demand, those who delay response face compounded disadvantages. Prices adjust, correlations shift, and liquidity patterns evolve, often before the average participant even recognizes the shift. Inaction in this context is not neutral. It is a form of exposure to loss, because every moment spent waiting is a moment when opportunities for gain are slipping away. Those who understand this dynamic position themselves early, using foresight and analysis to act, while others debate. Another crucial aspect is behavioral. Indecision is often rooted in fear, uncertainty, or over-reliance on perfect information. Markets, however, do not reward perfection, they reward calculated action. The hook here is counterintuitive. Accepting incomplete information and moving decisively often yields better outcomes than waiting for certainty. Institutions exploit this principle constantly. They commit capital based on probabilistic models, risk frameworks, and scenario planning, not on guaranteed outcomes. Delaying action in anticipation of clarity frequently results in being forced into reactive decisions at much worse terms. Strategically, the cost of inaction also manifests in compounding opportunity gaps. Early positioning allows participants to benefit not only from immediate price adjustments, but also from secondary effects, such as liquidity advantages, strategic partnerships, and market influence. Those who wait often face higher entry costs, tighter margins, and fewer choices. The hook lies in understanding that in dynamic markets, timing can be as important as the decision itself. Hesitation often transforms manageable risks into urgent crises. Finally, inaction limits learning. By abstaining from engagement, participants lose real-time feedback, which is essential for refining strategy and understanding market behavior. Each delayed decision reduces the ability to interpret signals, anticipate moves, and respond to future volatility. The most successful market actors embrace action as a tool for both capital allocation and continuous learning. Recognizing that doing nothing has a tangible economic cost, the subtle but powerful truth is that opportunity waits for no one. And in periods of structural change, the cost of hesitation is far greater than the cost of imperfect action. So as we stand at this crossroads, remember this: game over does not mean the end. It means the end of one phase and the beginning of another. Every ending is an invitation for those brave enough to step forward. The world does not pause for certainty, and markets do not wait for permission. They reward those who prepare before clarity arrives. Let this be the moment you choose awareness over fear, preparation over excuses, and long-term vision over short-term noise. Because when the dust settles, and it always does, the future will belong to those who understood the signals early and had the courage to act on them. Stay sharp, stay disciplined, and above all, stay ready, because history is being written right now and you still have a role to play.